Welcome back to Canada Accounting Insights. I promise today's topic will make inventory estimation a little less scary and a lot clearer. We're going to break down the two key methods that you absolutely have to know: gross profit and retail method. But first, help me out by hitting subscribe and dropping a like. It's quick, free, and way easier than reconciling a bank statement. All right, let's dive in. Just look at this. Can you imagine trying to count every single box in a warehouse this massive? It would take forever, cost a fortune, and you'd probably have to shut down the whole operation just to get it done. There has to be a better way, right? And that really gets to the heart of a matter. Why do companies estimate inventory anyway? It's not just about saving time or avoiding a tedious job. There are some really critical business reasons behind it. Yeah, it's about way more than just prepping those monthly or quarterly financial statements. Think about a worst-case scenario like a fire or a flood. How do you file insurance claim? You have to estimate your losses. It's also a great way to double-check your numbers if you're using another inventory system. It's like a financial sanity check. So how's it done? Let's jump into our first major technique. This one is a classic. It's all about using the past to figure out what's happening right now. It's called the gross profit method. The whole game with this method. Well, it's all based on one big assumption, that your company's gross profit percentage is pretty stable over time. So, if you've consistently made, say, a 40% gross profit on your sales in the past, this method bets you doing about the same thing this period. It's all about consistency. Just think of this as a simple 5-step process. You start with what you know, that historical gross profit percentage. From there, you can estimate your profit on the sales you just made. And that unlocks the next piece of the puzzle, your estimated cost of goods sold. Finally, you just subtract what you sold from what you had, and you're left with your ending inventory. It's a beautiful logical flow. Okay, let's make it real with an example. So this company knows its historical gross profit is 35%. That's our starting point. They take that 35% and apply it to their net sales, which gives them an estimated gross profit of $196,000. Now they can work backwards to find their estimated costs of goods sold. The last step: take the total goods they had, subtract what they probably sold, and bam, an estimated ending inventory of $156,000. All right, method 1 down. Let's switch gears to our second key technique. And this one, as you can probably guess from the name, is a huge deal for retailers. It's the retail method. So here's the big difference you need to remember. The gross profit method looked at historical data, right? Well, the retail method uses the current relationship between what an item costs and what it sells for. It's all about what's happening right now, which makes it super useful for stores that track their inventory at both cost and retail price. You can think of this method as a translation exercise. First, you figure out the relationship between the cost of your goods and their retail prices. That gives you a super important number called the cost-to-retail ratio. Then you figure out what your ending inventory is worth at its retail price. The final step is just using that ratio to translate the retail value back to what it likely cost you. And here it is with actual numbers. Check it out. The company has goods that cost some $80,000, but they're priced to sell for $120,000. So you divided the cost by the retail, and you get that key ratio about 67%. Okay, so we know the ending inventory is worth $28,000 on the shelves. We just apply our 67% ratio to that number, and it translates it back to an estimated cost of $18,668. Simple as that. Okay, so you've got the mechanics of both methods down. Now, what's really going to matter is knowing the difference between them, when to use which. So let's put them head to head to really lock this in. This right here is your ultimate cheat sheet. The gross profit method looks to the past using historical data. The retail method looks at the present using the current cost to retail ratio. And because of that, notice, they need different kinds of data to work. The core calculation is different too. Gross profit finds what you sold first, while retail finds what you have left first and then converts it. So what is the absolute bottom line? If you're cramming right now and you can only remember one thing from this whole lesson, please make it this. It's really this simple. Gross profit method equals past. It needs history. Retail method equals present. It uses current numbers. That's the key distinction. But don't forget, even though they're different, they're both trying to do the exact same thing. Give you a solid, reliable estimate of your inventory when you just can't count it. And I'll leave you with a classic exam question to chew on. Imagine a fire wipes out your entire inventory, but miraculously, your accounting records are safe. Which of these two powerful methods would you pull out of your toolbox to figure out the value of everything you lost for that insurance claim? Give it some thought. You've got this. Thanks for watching. If you found this video helpful, don't forget to leave your like and subscribe for more.